Hello and welcome back to another Facebook Live here from Stashaway. Welcome back. I have our CIO, Freddie Lim, again with us here.
Hi.
And we want to give you a quick update on a couple of things that's been happening in the market. There's been a lot of news since a couple of weeks ago when we had our last Facebook Live together.
Right.
And I just want to give a quick update, kind of our thoughts on what's going on, kind of what the next few weeks might look like here going forward, especially as we're heading into the election season in the US in November. So, by the way, if you have any questions throughout this live podcast, Facebook Live, please feel free to ask them in the comment section. We're happy to answer all of them. Also, over the weekend, if you watch this later on as a recording, please feel free to give us any comments. Freddie and I will be either addressing them next week, or one of our customer service people will definitely be addressing them as well. So with that, Freddie, lots to talk about, especially, I think, kind of starting Friday, right? After the Federal Reserve meeting, and the notes started to pour in from what they discussed, actually.
Right.
It seems like the bond markets are becoming a lot more interesting right now, huh? We're pretty muted, but because they've been, even though interest rates got raised, they were, they were still going up, bond price, but now it's kind of turning around.
You're exactly right, and the bond market is once again in focus, gaining a bit more respect, and the equity markets is now also watching the bond markets for cues to what's going to happen next. Now, if I step back a little, all this started with very weird, unusual communications from the Fed. As you knew, Fed Chairman Powell had a very conflicting statement.
Yes.
He said that inflation is tepid. Wow, that's reassuring. I don't need to hike rates very, very forcefully.
Yeah.
But immediately they say, well, it doesn't mean I can't go past neutral rate and raise to restrain the economy more. And that is where the confusion lies. And it's the way of delivery too, because when he say that, it's like inflation is tepid. Yeah, we can raise rates beyond neutral if we need to, probably. And the way of saying it has become very confusing for markets.
Yeah, and I think they like, normally what markets like is they like a what do we call it, like a Federal Reserve that literally says what they mean, right? It's black and white and not this wishy-washy kind of thing, right? This is what actually, because no one knows what to do with this kind of news, right? Like,
yes,
it could go either way right now.
Markets hates the lack of clarity, especially when it comes to policy.
Yeah.
But in this case, I think there's a very, very interesting truth here is neutral. Where rates are now versus neutral, the famous model is called the Taylor rule, which looks at inflation gap and output gap, where the economy is now versus equilibrium level. And so using that rule, which is very standard in the financial industry, there's a gap of 2.8% between Fed funds rate today and tomorrow. So by just saying I want to gravitate to neutral is already a big statement.
Yes,
it's
a big gap, right?
2.8% further increases in rates over time. So the Fed has always been emphasizing gradual. That has a calming effect on the markets. But right now, the confusion has been created recently, and the lack of clarity is really making the markets a little bit more volatile.
So then, as we just kind of moved over into the markets, right? So what did that mean over the last few days, or especially this week, right? What kind of maybe you can give a quick update to all the listeners of ours, kind of what that means to their portfolios and equities, bonds, what's happening.
So number one, what that means is that bond markets is starting to react quite a lot to it. And the interesting thing is that longer term bonds are reacting more. Here is a sign of overreaction because Fed policy is about short-term rates. So the lack of clarity has kind of priced in some sort of risk aversion into the bond interest curve. And so longer dated bonds are now becoming more volatile, for sure.
Yeah.
Number two, the equity markets has responded. As you knew, early in the week, companies like Netflix and a lot of the tech companies are trying to guide analysts' expectation down because the expectations are really quite high historically. They're trying to guide it down so that they can smooth out in the future.
Yeah.
So
the earnings call will be a little more relaxed.
As you know, future earnings, if it's got it down, and with a higher interest rate, discounting those potential future cash flow to present value, that discounting is now a bigger problem because interest rates are rising. So that created a double whammy on the stock markets over the last 2 days.
Yeah.
So S&P dropped 0.7%.
Yeah.
Tech stocks dropped about, if I remember correctly, it's about 1.5%.
Yeah.
So there's some volatility over the last 3 days, and it's not surprising.
So that this is happening on the equity side, right? But I know now a lot of people will say, okay, of course, interest rates have been so low, they can only go up, right? This is what's been happening actually throughout the last 4 or 5 years, right? With the markets in general. This is always everyone's fear. Mm-hmm. And with that, bonds have to drop. They never dropped yet, right? So this is the problem. They actually still made returns even last year, right? With rate hikes. And but now, are people actually seeing what's happening in their portfolios? Is the bond side not working so well? What do you still need to manage risk, right? I think that's where I want to get to. What's your opinion of a solid approach for investing in long term, right? And then having the right asset allocation for you at this point in time?
Well, even if times are good, there's always a place for bonds because the income is fixed. It has a certain function against just in case the equity market meltdown, you have the bond protection. It would still work if there's a meltdown in the equity markets. So you don't know the future, so you always need some fixed income in your portfolio. That never goes away. And so, which brings me to the point, when the bond market now is, in my opinion, overreacted to the statement, to the lack of certainty, and created a higher yielding asset for investors now. So dollar cost average into it. You still have the equity portion that you're averaging into. Do the same for the bond side. Build up that portfolio for the long term. Actually, this is an opportunity.
Yes, I totally agree, and I think people cannot lose track of their goals and just change portfolios now all into equity just because this is not the right risk level, right? Just because now they feel like bonds are.
Is it a trade for one time, or is it a long-term portfolio that you build towards to? So think about majority of your net worth should be in a savings-driven plan.
Yeah.
It's long-term. You have a monthly contributions. You dollar cost averaging into things. You build up over time the cushioning effect as returns start coming in. It strengthens the portfolio over time. Sometimes the market corrected downward, giving you better entry, giving you better reward to risk ratio. You keep building it. That focus is what will make your portfolio successful in the long term. It's not a trade. No. This is a life goal.
Yeah. No, I think correct, and this is when you are able to capture the best of the market and the worst at the right time, right? So you just keep putting the money in, as we've been preaching quite a bit. So just to wrap it up, then I have a couple of other topics that I want to talk about. So one of the things with this whole trade war thing was, how bad is it going to get, right? I think we saw already with NAFTA now being not much change, but it's back together. So repackaged, looks kind of the same still, not much changes.
What is it called again? USMCA?
Yeah.
Like a YMCA sort of thing. So Trump actually said he likes something that ends with MCA. He's a funny guy. It's just a rebranding of the name. It hasn't substantially changed. There's some nuance changes, but we wouldn't get into that. They're not substantial. But it's an effort to make a point to the world that it's America first, for sure, and also is to isolate China. The new things that goes in NAFTA is about how to protect more intellectual property rights. Yeah. You're doing it with Mexico. I'm like, why? You do it in Mexico. It's because you want to set a precedence and a template for future equivalent negotiations along the same framework. And it's all aimed at China, aimed at beefing up intellectual property rights, aimed at facilitating more free flows in trade, less state sponsorship that create a glass and steel industries in China, and you dump to the rest of the world markets. That sort of thing. They're actually very targeted. Yeah. It's not about the economics, it's not about the actual numbers, it's about setting a template, and it's about isolating China.
Yeah, and I think it's a blueprint of what Europe can look forward to, right? Because once he's done with China, which he now how many more billions can he do? Not many more.
Yes.
On imposing, and who is his next target, right? It seems quite straightforward, right?
Yeah, so let's put it this way. As of today, we have implemented tariffs on half of what the US imports from China.
Yeah.
And already we knew Trump has already threatened for some time to go all the way. The pricing, the information is embedded in the market's pricing already. How much more worse from trade war can it be?
Yeah.
In fact, Make America Great Again is making Brazil great again, because now China is retaliating with tariffs on US farm products, and they are instead importing from Brazil and other countries. It's actually making some countries in emerging markets over time strong again.
Yeah.
And I know emerging markets are cheap now, but look, a great opportunity to build up their portfolio over time, average in when they are cheaper, and focus on long-term growth.
Yeah, so no matter what the noise is, right? That's kind of the
Exactly.
message as always, because it's been just, this year has been a particular big on news and just key ongoing trade negotiations and things like that. But yeah, so again, thank you so much for listening today. I hope you all, have some great insights that you can take away from this. And please reach out to us. Either we have a great customer support team. You can reach them by phone and by email. So we're happy to answer any of your questions that you might have. So please feel free to reach out. Also here in the comments section, once again, Freddie and I will be discussing any of those questions next week. So thank you so much for chiming in, and have a wonderful weekend, everyone.